Is your portfolio living up to expectations? Or are you having a hard time deciding which investments you should hold? Stick around, because in this episode of MoneyLetter on Markets, we're going to give you 5 mutual funds and ETFs that are primed for success in 2025. I hope you find this edition of MoneyLetter on Markets useful and informative. If you want to learn more about our research and our investment newsletter, visit MoneyLetter.com. And if you want to see more videos like this, subscribe to our YouTube channel. That's it for now. See you next time. Hello, everyone. My name is Brian Kelly. I'm the publisher of the do-it-yourself investment newsletter, MoneyLetter. And I'm here today with Bruce Hardy. Bruce is the Director of Private Asset Management at Asset Strategy, MoneyLetter's sister company. What we're here today to do is to introduce a portfolio of mutual funds and ETFs to you that are good for 2025, primed for success, we'd like to say, recognizing what's going on in the market and economics. So, Bruce, if you would like to talk about some of the things that are going on in the market, and maybe after that we can get into introducing some of the funds that we wanted to talk about today.
Sure.
So thank you. Welcome.
Okay. Well, thank you, Brian. All of us are trying to get a grasp on what's going to happen as new policy initiatives and priorities take shape. But, clearly, where we start is we've enjoyed the last few years a very stable and resilient economic environment. And that certainly is an important baseline here that offers support for virtually all the work that we're doing. We've seen this expressed in good labor markets. Certainly we have job creation pretty steadily. We also have very favorable sort of jobless claims experience, people being laid off or leaving the workforce. As I say, we have job creation. But as you introduced, there is always uncertainty. With this, the Fed has been active in engaging in their policy to combat inflation. And we've reached the pivot last year when they began a program of reducing interest rates. And that certainly is a constructive and useful environment for investors and for markets. The Fed announced that they would not change interest rates at their regular meeting. And Chairman Powell went on to offer a little bit of detail and said, we're patient. We need some of these uncertainties to unfold and give us a firmer idea of what lies ahead before we take further action. So we may end up having an interesting sort of battle waged between the Fed and its mandate to remain independent, and certainly the White House's desire to drive interest rates down.
Yes, certainly.
So here we are. I've, in some of my talks and some of my writings, have sort of introduced sort of a dual-edged sword. We've got a lot of initiatives here that could, if they're implemented effectively, be very growth-oriented and could be a good boost to markets and represent good opportunity. But like anything, the other side is if they are not implemented properly or some of the initiatives fail to take shape, we run risks of either reinvigorating and stimulating inflationary concerns and pressures, or, unfortunately, the R word of recession is sort of back conversationally amongst many analysts and market participants. And some of what has influenced sort of at least my choices here for our gathering this morning is that we've come from a couple years of markets driven by the big AI, big tech message. It's the Magnificent Seven, if people are familiar with that term and concept. They've been driving the bus and have led to very, very favorable returns across markets. But like anything, when you get to high levels and high valuations. It introduces new potential risks and concerns. And
Of course.
know you had and made a point, and we saw a result of an announcement or a release of an AI product from a competitor of Chinese origin, DeepSeek,
Right.
and that led to the semiconductor industry really getting a wake-up call competitively, and that certainly gets your attention. So,
It sure does.
so here we are, and that gives us at least a context. Again, what we're doing here is we are using our analytics and tools that serve as the foundation for our MoneyLetter publication. So many of you may be subscribers and are familiar with all of the information and data that's included there. For those that aren't, certainly we'd encourage you to look at a sample and consider it, because this is sort of the beginning of this conversation is contained within those pages, and that's how we'll base sort of this short list of our 5 top choices to build this portfolio.
Well, of course, nobody has a crystal ball, but the consumer that, as you allude to, Bruce, has remained strong. There still looks to be the opportunity for a couple of Fed cuts in 2025, although that's in question, but that's still the forecast is as we do this video today. So what we're going to do now is try to introduce 5 funds basically in a diversified way, a diversified portfolio, which will include 2 domestic stock funds, 1 international stock fund, a specialty fund, and a bond fund. So in that way we can create a diversified portfolio to take advantage of opportunities in 2025. So with that said, and that being our assignment today, Bruce, why don't you introduce the first fund that we picked?
Sure. As I say, we'll start with our 2 domestic choices. Again, as you mentioned, Brian, diversification really is the goal. And as you may know or appreciate, it really is the first line of defense, particularly in uncertain and volatile times. If you have more narrowly focused types of approaches and strategies, you increase your risk, I think, unnecessarily. So, as I say, our overall goal in assembling this group was to offer some balance, offer some participation across different asset classes and credits. The first choices come from our current screenings and really recognize 2 factors. One being that in the top categories of these peer group rankings on the domestic side, about half of the top fund groups, whether we go 10 deep, 20 deep, 30 deep, they have in the last month been mid-cap oriented strategies. So the first is a Marsico mid-cap growth focus fund. Particularly within this Marsico fund, in fact, it has about 30% in technology. It is a narrower list of holdings within the portfolio. But in looking at it, while it has tech, again, you'll see, and I think we'll sort of present side by side some of the data so people can see as we go. You won't see, the Magnificent 7 at the tops of their lists. And that's really what we were trying to get at. So, it had good, solid results, and as I say, is screening very favorably as we launch things here in 2025. So it's MXXIX, Marsico Midcap Growth Focus is our first crack.
What's the second domestic stock fund, Bruce? That's a mid-cap as well.
That
right?
is a mid-cap as well. But I think here, we've got a situation where we're creating, or trying to create sort of complementary positions. While it is in the mid-cap space, The next choice is the Invesco S&P Midcap Momentum ETF. So it is an exchange-traded fund as opposed to a traditional active 40 fund, which was the Marsico.
The ticker is XMMO. XMMO.
Correct. Correct. Here, a bit different. It has a little bit broader portfolio number of holdings. And here, interestingly enough, the tech exposure is more in the area of about 6% of the overall portfolio. It places greater emphasis on a few other areas that we're interested in, which are financial services, consumer discretionary, industrials. So, here between these two funds, we bring together really representation and exposure to the spectrum of tech and these other segments of the market. So, again, it's participation is sort of key. We like not to be exclusionary because you don't know. Even though the big tech funds were winners in the past 2 years, and you say, well, where do you go from the top? Maybe you go farther.
Well, I can see that the XMMO fund returned 38% last year, so that was pretty good for that type of fund, a mid-cap growth fund. It wasn't. Its top holding is Williams-Sonoma. It's not NVIDIA or Google or Amazon. So that's interesting. The next fund would be an international fund, and it's not completely international, but it has a large lean to that. And that's the Barron Global Advantage Retail Fund, and the ticker is BGAFX. And why don't you tell us a little bit more about that, Bruce?
Well, I think you're absolutely right. Really, the top groups in the screening of the international segment have been labeled global as their investment style. And as a result, not shockingly, the best performing ones have been ones that have had pretty healthy allocations to what, by definition, are domestic stocks or domestic companies.
Sorry, Bruce, but we should probably tell the viewers that MoneyLetter sorts our international funds. Anything that has a relatively large exposure to international stocks we put in that category, and some of them do hold a fair amount of U.S. positions. So therefore, you'll see some of these funds that are called global funds will indeed have NVIDIA and the Mag 7 in there.
Yeah, they will, and certainly, one perspective is that while these companies may be domestic, their customers and their business is a global type of a business. So, it's perhaps a distinguishing definition without a meaning of great import, but certainly something we want to recognize because, well, with these global funds, they can exercise some discretion. Obviously their mandate is to try to optimize investment returns. So if the best place in town happens to be the U.S. market, wouldn't you place a healthy portion of investments there? So, certainly we recognize that, and we know that they may move from a range that could be lower in different market conditions and different economic conditions to higher. But we tried to get one in Barron that had a somewhat lower domestic exposure relative to some of its peers. So within that top group of global funds, in fact, the domestic percentage in some instances exceeded 70%. Yep. Which is pretty high. In the case of Barron, we've got 58%. Still seemingly high, but not as high because, again, our overriding goal here was to offer a diversifier, not simply a third domestic choice. So this sort of recognized sort of both objectives. Obviously, we want to have competitive, comparative results, but at the same time, we want to be true to our mission of offering a diversified approach.
Well, and if the U.S. market does struggle this year, this would be an opportunity for that diversification to really pay off. If I noticed European bank cut interest rates again this morning. They've been laggards, although some of the European stock markets have done well, but emerging markets have not been what we've expected. Some of these funds may advance if the markets are a little different than they were this past year in 2024.
Sure.
I noticed that Barron Global Advantage has quite a good 10-year track record. It was averaging 11.4%. Versus its benchmark, or the benchmark we picked for this video, which is EFA, which is a broadly diversified ETF internationally, at only 5.5%. So it's more than double the return over 10 years. So
Yeah.
that's interesting to see.
Well, certainly the Barron Group, and I've had an opportunity actually to meet with them in their offices in New York. They are a very talented group of analysts and managers, and clearly that's a testament to their ability to generate good, solid returns over an extended period, which suggests obviously things change. It isn't just a linear approach. They have to be responsive to changes in market and economic conditions. So I think that demonstrates that they've been effective at that.
That's right. So once again, that was Barron Global Advantage Retail, and the ticker is BGAFX. The fourth fund is a little bit new to me, and Bruce has done quite a bit of work on this one. It's called Global X Defense Tech ETF, and the ticker is SHLD. And this is, I think, an opportunity to take advantage of current conditions, what's going on in the world, what's going on in the U.S. So tell us a little bit about that,
Sure,
Bruce.
sure. I think that's right. Certainly, we can't, be oblivious and not be aware of sort of what is happening. Obviously, we've got very vocal and loud opinions being made on all topics.
That's one way to put it.
We'll kindly call it, aggressive rhetoric. And certainly a lot of it has focused on, deal from strength. And this has been a message that, President Trump is trying to express. And most recently, he sort of dusted off a theme from his first go-round, which was the concept of Iron Dome as a defensive initiative or strategy. Whether it's achievable. For us as a missile defense, we'll have to wait and see. But certainly that suggests that there is a commitment, to these types of programs and therefore these types of companies that would be engaged and provide either technology or physical tools to implement such an approach. We're trying to leverage and capture that message, and we'll have to see how it develops. But certainly, as we've gotten underway just since the elections, that group has performed reasonably well, and certainly. It represents globally a significant commitment of resources. Investments in defense are monstrous, not only as a percentage of each country's GDP, but we're talking serious numbers here, and if it's backed up by those strong statements, and the fact that we've got some conflicts globally that have everyone's attention. This seems to be something that offers some opportunity.
So this fund is in what we call our specialty section, and it's, as Bruce mentions, it's more or less a technology fund that's in the defense area. You'll recognize some of the names that it holds: Northrop Grumman, General Dynamics, Lockheed Martin. These are big players in the defense industry. The fund is relatively new. I think 2024 was its first full year of performance, and it did 35% last year. So that's something to keep an eye on, and as we say, it's kind of an opportunity play.
Yeah.
So once again, that's the Global X Defense Tech ETF, and the ticker is SHLD.
I think appropriate. Shield with that
Shield,
Iron
yeah,
Dome
that's right.
thought. Yeah.
And the final fund, since we have a diversified portfolio, is a bond fund. We couldn't leave without a bond fund. So we're offering this morning Fidelity Capital and Income, which is a high yield bond fund. The ticker is FAGIX. And this is a good performer, and I might mention some of those numbers after Bruce can tell us a little bit about this fund too.
Well, certainly, as you mentioned, it is a high yield fund. So really, it's investing in credits that are not AAA or AA and tend to be a little bit lower on the credit scale. But with that, there is some economic support. Obviously, when you're investing in lower credit types of loans or investments, what are you concerned about? You're concerned about credit risk, the ability for these companies to pay their loans and repay them. So it gets back to sort of the picture that we painted of the economy being pretty solid and pretty stable. So we've got very strong corporate balance sheets. We've got good economic conditions that say at least the credit risk within lending to high yield borrowers is not as high as it perhaps has been historically. And again, it offers some support to say, hey, that can be repaid, and any investor will indeed realize the favorable income spread that's offered, by those particular instruments.
You can see in the performance, like in 2024, this fund, Fidelity Capital and Income, returned 10.7%. If you compare that against AGG, which is the iShares Barclays, it's basically the proxy for the general bond market, that only did less than 1%. So 2024 was a good year. The 10-year performance, almost 7% per year. The ag was only 1.2. So yes, there's additional risk. You're getting paid for that. But given the current conditions of the economy, and as you point out, balance sheets are good and the credit risk is relatively low.
Right.
We think it's an opportune time to take a look at that fund. So that's
Yeah,
Fidelity Capital and Income, and the ticker is FAGIX. So those are the 5 funds that we've offered. If you want to learn more about these funds and learn more about our newsletter, it's MoneyLetter. You can go to our website, MoneyLetter.com. And if you want to see more videos like this, you can subscribe to our YouTube channel. We really appreciate you checking in with us and watching this video. Bruce, thank you very much for your time and research.
Well, thank you for having me this morning.
We appreciate it, and we look forward to seeing you again the next time we do this.